Something unprecedented is happening in the silver market right now that most people don't see coming. While everyone's watching Bitcoin and gold, a crisis is building in physical silver that could trigger the most explosive price surge in decades. And the banks that have controlled this market for years are about to lose control completely. 5 major US banks are sitting on short positions worth billions of dollars in silver. These aren't small bets. We're talking about contracts representing over 700 million ounces of silver that these banks have promised to deliver but don't actually own. And right now, with physical silver becoming impossible to find, these banks are facing a nightmare scenario that could force silver prices to levels nobody thought possible. The numbers are staggering. The Silver Institute just reported that 2024 saw the largest physical silver deficit in recorded history. 265 million ounces more silver was consumed than was mined from the ground. That's not a small shortage. That's a supply crisis that's been building for 5 consecutive years, and it's accelerating faster than anyone anticipated. But here's what makes this different from every other commodity shortage you've heard about. Silver isn't just money. It's not just an investment. Silver has become absolutely critical to the technologies that are reshaping our entire economy. Every solar panel, every electric vehicle, every smartphone, every computer chip requires silver to function. And the demand from these industries is exploding at rates that are completely overwhelming global mine production. Let me show you exactly how this crisis developed and why the banks that have manipulated silver prices for decades are about to face a reckoning that could send silver to $100 an ounce or higher. Because what's happening right now isn't just a supply shortage. It's the collapse of an artificial pricing system that has kept silver suppressed for years, while physical demand reached breaking points. In 2024, industrial demand for silver hit an all-time record of 680 million ounces. That's an 11% increase from the previous year, and analysts are projecting that industrial use will exceed 700 million ounces for the first time in history during 2025. Solar panel manufacturing alone consumed 232 million ounces last year, up from just 60 million ounces in 2015. That's nearly a 400% increase in less than a decade. Electric vehicle production is adding massive new demand that didn't exist 5 years ago. Each electric vehicle requires between 25 to 50 grams of silver for basic components, but the next generation of EV batteries could require up to 1 full kilogram of silver per vehicle. With over 17 million electric vehicles projected to be manufactured globally in 2025, an EV market share expected to exceed 60% in major markets by 2030, we're looking at silver demand that's growing exponentially every single year. The problem is that mine production can't keep pace. Global silver mine output increased by only 2% in 2024, reaching 844 million ounces. But industrial demand alone consumed 680 million ounces, leaving just 164 million ounces for investment demand, jewelry manufacturing, and everything else. When you factor in that total silver demand reached 1.2 billion ounces in 2024, the mathematics become impossible to ignore. This is where the banks created their own disaster. For decades, major financial institutions have maintained massive short positions in silver through futures contracts on exchanges like COMEX. These short positions allowed banks to essentially create paper silver that doesn't exist physically, flooding the market with artificial supply that kept prices artificially low. The strategy worked perfectly as long as most traders were satisfied with cash settlements instead of demanding physical delivery. But something fundamental changed in the physical silver market that the banks didn't anticipate. Industrial users started demanding actual delivery of the metal they purchased. Solar panel manufacturers can't build their products with paper promises. Electric vehicle companies can't install paper silver into their battery systems. These industries need real physical silver, and they need massive quantities of it delivered on schedule. The COMEX exchange, where most silver trading occurs, holds about 300 million ounces of silver in total inventory. But only about 73 million ounces of that silver is actually available for delivery. The rest is either allocated to specific owners or tied up in other financial arrangements. Meanwhile, London Bullion Market Association vaults hold approximately 827 million ounces, but that inventory has dropped to near all-time lows and continues falling as industrial demand pulls physical silver out of the system faster than it can be replaced. Here's where the mathematics become terrifying for the banks. Open interest in COMEX silver futures contracts represents claims on over 700 million ounces of silver, but deliverable inventory stands at just 73 million ounces. That means there are nearly 10 paper claims for every ounce of physical silver that can actually be delivered. If even a small percentage of contract holders demand physical delivery instead of cash settlement, the entire system collapses. This imbalance has created what industry experts call the greatest disconnect between paper and physical markets in silver's history. Some analysts estimate that paper claims exceed physical silver availability by ratios of 400 to 450 to 1 when you include all the various financial instruments and ETFs that claim to be backed by silver. Keith Neumeyer, CEO of First Majestic Silver, has been warning about this crisis for years, stating that the market deficit of approximately 240 million ounces annually is climbing every single year with no relief in sight. the US Mint provided a stark example of how severe the physical shortage has become. In 2024, the Mint produced only 20% of the silver eagles it manufactured in 2023. That represents an 80% reduction in production of the most popular silver investment product in America. This wasn't due to lack of demand. This was purely a supply issue. The Mint couldn't source enough silver to maintain normal production levels. Precious metals dealers are reporting unprecedented difficulties obtaining basic silver products. Industry veterans describe recent periods where silver maple leaf coins and standard investment bars became nearly impossible to source for weeks at a time. These shortages occurred despite relatively quiet retail investment demand, suggesting that institutional buyers and industrial users are absorbing available supply before it reaches traditional retail channels. The London silver market demonstrates how disconnected paper trading has become from physical reality. Average daily trading in London's promissory note silver market reached 214 million ounces in October 2024. This implies total standing claims for silver in London's cash market of approximately 3.86 billion ounces. Compare that massive paper obligation to the actual London vault holdings of 851 million ounces, and you see claims that exceed physical inventory by more than 4 to 1. Major silver-backed ETFs, like the iShares Silver Trust, add another layer of complexity to this crisis. SLV claims to hold 100 million ounces of silver stored by JP Chase, but critics argue this same silver might also be counted as COMEX inventory, creating double counting that makes actual available silver even scarcer than official reports suggest. If true, the real shortage could be far worse than anyone realizes. The banking sector's exposure to this crisis extends beyond just their short positions in futures markets. Regional banks hold significant concentrations of loans to mining companies and industrial silver users. When silver prices spike dramatically, it creates massive volatility throughout the supply chain that can impact loan portfolios and credit facilities tied to commodity-dependent businesses. What makes this situation particularly dangerous for the banks is that, unlike previous commodity shortages that eventually resolved through higher prices encouraging new production, silver faces structural supply constraints that can't be easily overcome. New silver mine discoveries have declined dramatically over the past decade. Most existing mines are depleting their highest grade deposits, and the lead time to develop new silver mining operations typically exceeds 7 to 10 years. This means that even if silver prices double or triple, new mine production won't meaningfully increase for years. Meanwhile, industrial demand continues growing exponentially as solar installation targets become government mandates worldwide and electric vehicle adoption accelerates beyond all previous projections. The supply deficit isn't temporary, it's structural, and it's getting worse every quarter. The banking industry finds itself trapped in a position they've never experienced before. These institutions built their silver trading strategies around the assumption that physical demand would remain predictable and manageable. They counted on being able to settle most contracts with cash rather than actual metal delivery. But industrial users have fundamentally changed the game by requiring physical silver for manufacturing processes that can't accept paper substitutes. JP Chase, Bank of America, Citigroup, and other major financial institutions now face what traders call a perfect storm scenario. Their short positions were profitable for years when silver traded in the $20 to $30 range. But every dollar increase in silver price creates massive mark-to-market losses on positions that represent hundreds of millions of ounces. At current silver prices approaching $50 per ounce, these banks are already sitting on paper losses measured in billions of dollars. The situation becomes exponentially worse if they're forced to actually deliver physical silver to settle contracts. Purchasing 700 million ounces of silver in the open market would require buying virtually every available ounce in COMEX and London vaults multiple times over. The buying pressure alone would send prices into triple digits within weeks, creating losses that could threaten the stability of institutions that seem too big to fail. Michael DiRienzo, president of the Silver Institute, recently highlighted how photovoltaic solar manufacturing now represents more than 30% of total industrial silver demand. This sector alone consumed 232 million ounces in 2024, and government renewable energy mandates virtually guarantee this demand will continue growing regardless of price. Solar panel manufacturers have no substitute for silver's unique electrical conductivity properties. They must have physical silver to produce their products, and they're willing to pay whatever price necessary to secure supply. Electric vehicle manufacturers face similar constraints with even more dramatic growth trajectories ahead. Current EV models use relatively modest amounts of silver for basic electrical components, but next-generation battery technologies and autonomous driving systems require exponentially more silver per vehicle. Tesla, GM, Ford, and other automakers are already securing long-term silver supply contracts to guarantee access to the metal they'll need for production scaling planned through 2030. The smartphone and electronics industries add another layer of inescapable demand that continues growing as global technology adoption accelerates. Every iPhone, Android device, laptop, and computer server requires silver for circuit boards and electrical connections. With billions of devices manufactured annually and replacement cycles driving continuous demand, electronics manufacturers represent a massive source of silver consumption that operates independently of investment market dynamics. These industrial users don't trade silver futures or participate in paper markets. They purchase physical silver through direct contracts with mining companies and metal dealers. Their buying removes silver permanently from available supply, creating what economists call inelastic demand. No matter how high silver prices rise, these manufacturers must continue purchasing because their products cannot function without silver. Mining companies face their own crisis that prevents them from significantly increasing production, even with higher silver prices providing economic incentives. Keith Neumeyer of First Majestic Silver explains that mining operations require massive capital investments with development timelines spanning years or decades. Environmental permitting, infrastructure development, and extraction equipment installation create bottlenecks that cannot be overcome quickly, regardless of market prices. Most concerning for future supply, the quality of remaining silver deposits continues declining as the highest grade mines become depleted. New discoveries contain lower concentrations of silver that require more energy and resources to extract. This means production costs are rising even as industrial demand accelerates, creating a fundamental supply-demand imbalance that becomes more severe over time rather than self-correcting through normal market mechanisms. The Commodities Futures Trading Commission data reveals the concentration of short positions among just 5 US banks has reached levels that regulators previously considered impossible. These institutions control short positions equivalent to more than 100 days of global mine production. Their collective exposure to rising silver prices creates systemic risk that extends far beyond their individual balance sheets. When Bear Stearns collapsed in 2008, the firm's commodities trading division held massive short positions in precious metals that had to be unwound during the financial crisis. JP Morgan acquired those positions along with Bear Stearns, adding to their existing silver exposure. Similar consolidation throughout the banking industry means that silver market risks are concentrated among fewer institutions with larger individual exposures than ever before. The Federal Reserve and other central banks face an impossible choice as this crisis develops. Supporting the banks requires intervention in commodity markets that could distort global industrial supply chains. But allowing major financial institutions to fail due to silver trading losses could trigger broader financial system instability. Unlike previous banking crises that involved real estate or equity markets, silver's role in critical technologies makes this situation uniquely complex. International markets compound the pressure through currency dynamics that make dollar-denominated silver increasingly expensive for foreign buyers. As the Federal Reserve maintains elevated interest rates to combat inflation, foreign manufacturers must pay more dollars to purchase the same amount of silver. This creates additional demand from international buyers seeking to secure silver supplies before currency fluctuations make purchases even more expensive. China represents the largest source of international silver demand through massive solar panel manufacturing operations and aggressive electric vehicle production targets. Chinese companies are already securing long-term silver supply contracts directly with mining operations in Peru, Mexico, and other major producing countries. These bilateral agreements bypass traditional commodity exchanges entirely, removing even more physical silver from markets where banks need to source metal for contract settlements. Russia's exclusion from Western financial systems has forced Russian industrial companies to accumulate physical silver stockpiles rather than relying on paper contracts or Western banking relationships. Similar dynamics are developing across other countries as geopolitical tensions encourage nations to secure strategic metal reserves through direct ownership rather than financial instruments. The timing of this crisis couldn't be worse for banks already facing pressure from commercial real estate losses and regional banking sector instability. Many institutions that hold large silver short positions also have significant exposure to office building loans and other commercial properties that are defaulting as interest rates remain elevated. Adding massive silver-related losses to existing credit problems creates capital adequacy issues that could force banks to raise emergency funds or face regulatory intervention. Market makers and authorized participants in silver ETFs find themselves caught between institutional demand for shares and their inability to source physical silver to back new issuances. When large investors purchase millions of shares in silver ETFs, the authorized participants must acquire equivalent amounts of physical silver to maintain backing ratios. But with deliverable silver inventory at historic lows, these market makers face the same sourcing problems as industrial manufacturers. The disconnect between paper and physical silver markets has reached levels that some analysts compare to the oil market in 1979, when supply disruptions sent prices from $15 to over $40 per barrel within months. Silver's situation appears even more extreme because industrial demand provides a floor under prices that didn't exist in previous precious metals bull markets, driven primarily by investment speculation. Robert Kiyosaki, author of Rich Dad, Poor Dad, recently predicted silver could reach between $100 and $500 per ounce by 2027, based on the supply deficit mathematics and banking sector exposure. While such predictions might seem extreme, the fundamental drivers supporting dramatically higher silver prices are becoming more compelling each quarter as the physical shortage intensifies while industrial demand accelerates. Technical analysis of silver price charts shows the metal breaking through resistance levels that held for over a decade. When commodities break multi-year resistance during supply shortage conditions, historical patterns suggest price moves often exceed all previous predictions as short covering and panic buying create momentum that feeds on itself until physical supply and demand reach new equilibrium levels. The next phase of this crisis will likely involve the first major bank attempting to exit their silver short positions through massive physical purchases. When that buying begins, it will signal to other banks that the artificial pricing system has collapsed permanently. The resulting scramble to cover short positions could create the most explosive commodity price surge in modern financial history as institutions compete for limited physical silver supplies that cannot be increased quickly enough to meet demand. Sophisticated investors who understand this crisis are already positioning themselves for what many consider the trade of the decade. Unlike previous precious metals rallies driven primarily by monetary policy or currency debasement, this silver surge is powered by industrial necessity that cannot be postponed or substituted. Manufacturing companies need physical silver regardless of price because their products simply cannot function without it. The mathematical certainty of this outcome becomes clearer when you examine the timeline of contracts coming due over the next 18 months. COMEX futures contracts representing approximately 400 million ounces of silver expire between now and December 2026. Historically, less than 3% of these contracts result in physical delivery requests, but industrial users are changing that pattern by demanding actual metal instead of accepting cash settlements. If delivery requests increase to even 10% of expiring contracts, the system faces an immediate crisis, requiring 40 million ounces of physical silver that simply doesn't exist in deliverable form. The banks holding short positions would be forced to purchase silver in spot markets already depleted by industrial demand, creating a buying frenzy that could send prices vertical within days. Professional traders call this scenario a short squeeze, but the silver situation transcends normal market mechanics because the shortage is real rather than artificially created. In typical short squeeze events, higher prices eventually attract enough new supply to satisfy demand and stabilize markets. Silver's industrial applications prevent this normal price discovery process from functioning because manufacturers must have the metal regardless of cost. Goldman Sachs recently issued internal memos warning their commodity trading desk about unprecedented volatility risks in precious metals markets. While the bank hasn't publicly disclosed their silver exposure, trading floor sources suggest Goldman holds short positions exceeding 50 million ounces through various instruments. At current price levels approaching $50 per ounce, those positions represent potential losses exceeding $2.5 billion if prices reach triple digits. The psychological aspect of this crisis amplifies the financial mathematics because fear creates irrational behavior that accelerates price movements beyond fundamental justification. When silver breaks through $60 per ounce, institutional panic buying could drive prices to $80 or $90 within weeks as banks scramble to limit losses before they become catastrophic. Warren Buffett demonstrated his understanding of silver's unique properties during the late 1990s when Berkshire Hathaway accumulated nearly 130 million ounces of physical silver. Buffett sold that position in the early 2000s, but his recent comments about commodity scarcity suggest he recognizes the current situation represents something far more significant than his previous silver investment. Central bank gold purchases reached record levels in 2024 as monetary authorities diversified away from dollar-dominated reserves. Several smaller central banks have begun accumulating silver alongside gold, recognizing that industrial demand provides price support that pure monetary metals lack. When central banks start competing with industrial users for physical silver, the supply shortage becomes exponentially worse. The Federal Reserve faces an impossible choice that will define monetary policy for the next decade. Supporting major banks through direct intervention in silver markets would require purchasing massive quantities of physical metal that doesn't exist. But allowing systemically important financial institutions to fail due to commodity trading losses could trigger broader financial instability comparable to 2008. Unlike the mortgage crisis where toxic assets could be transferred to government entities and gradually unwound, physical silver shortages cannot be resolved through financial engineering. The metal either exists or it doesn't. Industrial companies either receive their silver deliveries or their production lines shut down. There are no synthetic substitutes for silver's unique properties in critical applications. Keith Neumeier's prediction of triple-digit silver prices isn't based on speculation or market manipulation theories. First Majestic Silver operates actual mines that produce physical silver, giving Neumeier direct insight into production costs costs, reserve depletion rates, and the massive capital requirements needed to develop new sources of supply. His company's inability to significantly increase production despite higher prices demonstrates the structural nature of the supply crisis. Mining executives across the industry confirm that current silver prices, even at $50 per ounce, don't provide sufficient profit margins to justify the massive investments required for new mine development. Environmental regulations, permitting delays, and infrastructure costs have increased the minimum viable silver price to levels that seemed impossible just 5 years ago. The pieces are all in place. Record deficits, unprecedented industrial demand, depleted inventories, and banks trapped in positions they can't escape. This isn't a prediction about what might happen. This is mathematics playing out in real time. When the first major bank breaks and starts buying physical silver to cover their shorts, every other institution will follow within days. The artificial pricing system that kept silver suppressed for decades is about to collapse completely, and the resulting price explosion could make early Bitcoin adopters look conservative.